Hello everyone out there, coming to you today to talk about the Fed rate cut cycle. Now that the Fed has, quote, pivoted and cut rates 50 basis points, which is 0.5%, what does history tell us that means for the markets? We're going to dive in and look at a few different charts and we'll see what happens. In our first chart, we're going to look at the effective federal funds rate, which is the current interest rate that the Fed's, had until a week and a half ago, or say 2 weeks ago, versus the 2-year Treasury bond rate. And the story here is the Feds really don't have a lot of control over the bond market. They just like to try to convey confidence in us that they do. In this first chart, you'll notice the blue line up at the top here represents the 2-year Treasury bond rate. The red represents the current Fed funds rate. We're going to reference two time periods. Back before the 2008 financial crisis, you'll see how the red line is kind of flatlined there. That means they held their rate, the Feds did at that 5.25 back then. And it's basically the same number that we have now in our current cycle at 5.25. What we're pointing out here, the Fed comes out and tells us that they're not behind the curve, that they feel that we have good employment and that inflation has come down far enough that they now can cut rates. I'm here to tell you that that's not why they're cutting rates. They're cutting rates because bonds are telling them they better cut rates because the economy is not good. The blue line leads the red line. So if you look at the blue line going down first, really sharply in our current cycle, that's why the Fed's cutting rates. And I actually bet that they'll be cutting rates 50 basis points again in the next meeting. And there's other factors that go into this, but this chart tells us that the Fed is behind the curve, in my opinion. So now that we've covered the red line versus blue line, I would like to point out that the grayish blue bars here represent recessions. So when rates begin being cut, that's because the government or Feds feel that they've effectively, quote, choked off the economy. I think that you and I both know people aren't buying cars, they can't afford houses, we're all kind of struggling just to pay for the regular everyday items. That's where we've got. The Fed is cutting rates because the economy is poor. So this little statement here, not really a slide, but I just want to point out some data that we've been able to dig up. Back in August of 2007, Janet Yellen was conveying to everyone that we were going to have a soft landing. We did not have a soft landing in 2008, did we? She's again back at it. They're conveying that we're going to have a soft landing. And what I'd like to point out, I don't want you to believe anything that the people on TV are telling you. They have lost all credibility over many, many cycles. They don't serve a lot of purpose in our current economy besides trying to get the masses to believe them. Economically speaking, they're wrong. In our next slide, we're going to look at the 10-year Treasury bond rate versus the 2-year. This is interesting because it's what they call yield inversion, meaning at one point when the purple is under the break-even line, the shaded area, you were getting more interest on a 2-year Treasury bill than you were a 10-year. That doesn't make sense. You should get more money the longer you let someone have your money, right? A higher rate of interest. Well, things have went back to normal, and now the 2-year is paying less than the 10. That's what this chart's showing you over here, where it says 0.20%. The yield curve is now positive. What I'd like for you to take away from this slide is that every time we become positive on the yield curve, another one of those gray bars shows up, and I think by now we're all aware that those gray bars are recessions. We're staring one in the face again based on this data point. We need to remain cautious and short the market so that we protect ourselves when that happens. So now that we've looked at a few data points, what does it mean when the Fed cuts rates? What does it mean if they would have cut 25 basis points versus 50? This next slide is going to show us just that. On this slide, you're noticing a lot of different data. The red line is when the Fed has cut 25 basis points. The blue line is when they have cut 50 basis points. Remember, that just means 0.25% or 0.5%. In our industry, they use the term basis points. The orange line up and down on your screen shows when the first cut had taken place. So what we're pointing out here, there's most recent years at the bottom, where they had cut either 50 or 25 basis points. Really, if you recall, we're interested in '07 because the effective Fed funds rate was the same as it is now. The yield inversion was about the same time. It all kind of lines up actually very eerily similar. So when the Fed cuts, you'll see we're interested in blue lines because they did cut 50 basis points. The market tends to go up for another week or two, sometimes as many as 20 trading sessions, which is 4 weeks. What that is, most of the time, is institutional investors, like big hedge fund guys, trying to hold the market up and live on the euphoria that the media is selling to the public that cutting 50 basis points is positive. It's never positive. It has never been positive. What they're trying to do is to sell their shares out so they can get out of the market. You get a little bit of a melt up and then it falls down from there. Really, you're seeing the same thing right now. If you've paid attention to the market since the rate cut, which has been right at 2 weeks now, been a lot of sideways action, and there's starting to be pressure to the downside. So we expect this analog to continue to play out. The pressure will be to the downside from here. In our last chart, what does it really mean after the Fed cuts rates? We're interested in what has happened to returns on the stock market. This chart is going to show you actual past cycles. So again, going back to what is most like the current environment, I think this 2007 timeframe is. The market back then, when the Fed cut 50 basis points to start, rolled over 58% from there. We are now trading at some of the highest multiples the S&P's ever seen. You're running on an AI bubble. The people can't afford houses. There's all kinds of reasons to why this is actually possible, and we remain short. So, this is not to scare you. This is to let you know how we're positioned. Most recent time periods, 2000, the S&P 500 fell 51%. 2007, we had a 58% drawback. 2019, a 35%, and here we are in a different cycle. Markets move quickly nowadays. It's all news-driven, data-dependent. Computers trade all this stuff. So, these things can happen really quickly. That's why we remain positioned bearishly. So to sum up today, the Fed cutting interest rates is not bullish. It is not achieving a soft landing, and it's not something that we should celebrate. The media would like us to think differently. They're doing everything they can to control our emotions. They know what's coming. The Fed cuts 50 basis points because the market is broken, the economy is broken. We'll just see that play out over time. There's a few data points that I have written down that I'd like to share, and I'll try not to be too lengthy here, but there's some strange things happening in the market. So stocks are rising like we've already achieved a soft landing. Really strange when unemployment's up and people can't afford houses, and Chrysler and Ford and all these guys, their stocks are down 30-40% because they can't sell cars. It just doesn't make sense. Now, on the flip side, gold is rising like we're in a major economic crisis. We're up over 30% on our gold holdings this year. That doesn't usually work that way. Market goes down, gold goes up. They don't go up together. Going up together, one of them's wrong, and gold, historically, never been wrong. Bonds are falling like the Fed is done cutting rates. That doesn't really make any sense either. Real estate prices are rising like rate cuts just started. Oil prices are falling like demand is disappearing. Now that one is very interesting. Oil is very good at predicting recessions and slow economic times, and oil really can't even get over $68 a barrel. A lot of these companies have to have $70 a barrel to break even. It tells you that there's no demand. China buys more cars than us and does more things in the world, and even though buys more goods. Even though they have tried to stimulate their economy, I don't think that that's going to cut it either. And natural gas prices are rising like demand is growing, which is not true based on economic data from manufacturing. So, we're just in a very strange environment. We remain very short the market at this point. We're at the peak, and this is where you want to short. And I want to describe that just briefly. But short, again, market goes down, we go up. We are inverse the market. So pay attention. You're going to start seeing that happen as the market melts down. We will go up and we will start selling those positions as we go up.